How to start investing money for the first time. The most surefire approach to accumulate wealth over time is to invest your money. Here are a few tips for a first-time investor. You'll need a basic understanding of how to invest your money properly before you put your hard-earned money into an investment vehicle. You should think about your investing style, your spending limit, and your risk tolerance when determining that. 1. Your style. How much time are you willing to devote in your financial decisions? When it comes to the many ways to invest money, there are two main categories in the investing world: active investment and passive investing. Active investing means doing your own research on potential investments as well as building and managing your own portfolio. Active investing requires extensive research. You'll need to look for potential investment possibilities, perform some fundamental analysis, and monitor your investments once you've made them. Active investing undoubtedly has the potential to generate higher returns, but you must be willing to put in the time to do it properly. Instead of flying an airplane manually, passive investment is comparable to setting it on autopilot. Over time, you'll still obtain good outcomes, and it takes far less work. In a nutshell, passive investing entails using investment vehicles where the hard work is already being done by someone else. Mutual fund investing is an example of this method. Or you could employ a mixed strategy. For instance, you may employ a robo-advisor to create and implement an investing strategy on your behalf instead of hiring a financial or investment advisor. 2. Your budget. How much money are you willing to put up? Although you might believe that you need a significant number of money to establish a portfolio, you can start investing with just $100. The most crucial factor is to ensure that you are financially prepared to invest and that you consistently make investments over time, not the amount of money you start with. Establishing an emergency fund is a crucial step before investing. All investments, whether stocks, mutual funds, or real estate, have some level of risk. You never want to find yourself having to sell or divest your investments in a time of need. Your safety net to prevent this is the emergency fund. The majority of financial experts recommend that the ideal amount for an emergency fund be sufficient to cover costs for 6 months. Your risk tolerance. What level of financial risk are you ready to accept? Not all investments are successful. Each investment type carries a unique level of risk, but returns and risk are frequently associated. It's crucial to strike a balance between increasing your financial returns and determining how much risk you can tolerate. Bonds, for instance, yield comparatively low returns of just 2% to 3% but offer consistent returns with very low risk. In contrast, stock returns can differ significantly depending on the firm and the period, but the overall stock market typically generates returns of close to 10% annually. What should you put your money towards, then? Your investment objectives will determine the appropriate sort of investment. However, after hearing the above recommendations, you should be in a much better position to choose what to invest in. For instance, if you have a moderately high risk tolerance as well as the time and willingness to thoroughly analyze specific stocks, and to learn how to do it correctly, that might be the best choice. Bond investments, or bond funds, may be a better option if you have a low risk tolerance but yet desire larger returns than you would obtain from a savings account. Put your money in passive investments like index funds or mutual funds if, like the majority of Americans, you don't want to spend hours managing your portfolio. And a robo-advisor may be the best option for you if you truly want to take a hands-off approach. The conclusion: if you've never invested money before, it could seem intimidating. However, to make wise financial decisions that will benefit you for years to come, you must first determine how you want to invest, how much money you should invest, and your level of risk tolerance.